Welcome to the second and final day of the RETCON Office Summit. We have an amazing lineup of speakers to learn from today, along with equally notable attendees to network with. If you didn't say hi to that special person yesterday, the time is now. To kick us off today, I'm excited to introduce Ryan Severino. Ryan Severino is the chief economist at JLL, where he manages the economics team and is responsible for global and regional economic research, analysis, and forecasting, as well as property market forecasting. Additionally, Ryan serves as an adjunct professor of finance and economics at Columbia University and New York University, teaching courses such as urban economics, portfolio and risk management, microeconomics, and macroeconomics. He also has experience in real estate asset management, portfolio management, and acquisitions. Ryan's original research has appeared in a number of journals, such as the Wharton Real Estate Review and the Real Estate Finance Journal. His assessments of market conditions have appeared in international publications like The Economist, The Wall Street Journal, The New York Times, and The Financial Times, and on business networks such as CNBC and Bloomberg. Ryan is a member of the CFA Institute, the American Economic Association, ULI, and NACREIF. Please join me in welcoming Ryan to the stage.
I have entitled this presentation, Economic Perspectives Go for Launch. And at this stage of my career, I have earned my reputation as being someone objective and independent. I don't pander to the audience. I don't pull my punches. If I'm going to use a subtitle like Go for Launch, I probably better have good reasons for doing that. And I feel confident in using this subtitle, and that's really what I want to discuss with everyone today. How I see the world, because it's an objectively interesting time to be talking about the economy. Not that I'm completely unbiased in that sense, working as an economist, but we are really on the precipice of what I think could be incredibly interesting and even exciting times in the economy that hold incredible implications for the real estate markets broadly and certainly the office market. And I want to view this through the lens of perspectives because I think that is a very important and informative way to think through what is likely to transpire in the economy and ultimately what it means for those of us interested in real estate. I want to start with the short run perspective. And I emphasize short run over the next year or so. And I say that we might never see this again in our lifetimes. And there I go being incendiary again, but I sincerely mean that. Why do I say that? First, I want to take a look at my crystal ball and how I'm viewing the world, and then I will give you some sense of why I feel that way. Rather than extolling the virtues of my super awesome scenario modeling capabilities, what I really want to emphasize is just the magnitude of how strong the projected growth rates are, even for what I'm loosely calling the downside scenarios, because those are far from what I would consider to be a downside in more normal times. I think across the range of possibilities for the economy this year in the short run, we are seeing very strong prognostications, not just from myself, but I think pretty universally across those of us who are responsible for forecasting where we think the economy is going. Well ahead of what I would term as capacity growth. If you're not familiar with the concept of capacity growth, think about the long-run potential growth rate of the economy. Fundamentally, economics is about taking inputs, doing something with them, and then converting them into outputs. And that's how we measure economic production. That's really what GDP is after. I'm going to come back to that concept in a few slides, but for now, the point that I want to emphasize is that these growth rates, especially the base case to the upside, are well ahead of what I would call pre-pandemic capacity growth, that long-term growth rate that most economists like myself were trying to estimate before we got into this mess. And I'd say we, as a group, estimated it was probably somewhere in the ballpark of 1.7, 1.8%. Therefore, if we see anything like the growth rates that I'm showing you on the bottom of this slide, we are going to be hundreds of basis points in excess of potential growth. which raises an important question. If I'm going to say something like, well, we might not see this again in our lifetimes, why do I think that way? I think that way because if you look back at the history of the US economy, you don't see these kinds of growth rates very often. How long's it been? Well, let's put that into some context. The last time the US economy in a calendar year grew at 4% or greater was calendar year 2000, when we were still dealing with the implosion of the dot-com bubble, about 21 or so years ago. The last time the economy grew at least 5% or greater, or 6% or greater, or 7% or greater was all the way back in 1984, when I was more concerned about playing soccer and Atari with my friends than I was concerned about anything remotely related to the economy, about 37 years ago, a pretty long time ago. And the last time that we saw growth in the United States in a calendar year of 8% or greater was all the way back in 1951, before most of us in the United States were actually born. That's why I say we legitimately might not see this again in our lifetimes. I shudder to say this, but it might take another crisis of this caliber to produce the kind of concentration of events that are really coming together at the right time to produce these robust growth rates, which raises the question, well, what kind of concentration of events, right? What kind of things are conspiring together to produce the kind of growth rates that I think we could see this year? And with this, I want to turn to an image more than I want to turn to any math. And I've been calling this the perfect storm recovery. If you think back to that somewhat cheesy Mark Wahlberg, George Clooney movie of 20 or so years ago, that's the way I think about this. And what do I mean by that? What I mean by that is there are these different components that are coming together that are producing this perfect storm kind of recovery. I want to talk about the factors on the left first, and then I will talk about the ones over on the right. The factors on the left are not unique to this recovery. In almost every economic recovery going back through time, certainly in modern economic history in the United States, we've had loose monetary policy, we've had a fiscal stimulus response, and then we've had pro-cyclical forces, which basically just means the economy gets its legs underneath it and starts to heal itself and start growing again. Those three things are not unique, but it's the magnitude of those things that's different relative to cycles past. Dovish monetary policy, the Fed is still holding the line on interest rates at the short end of the curve. And even at the long end of the curve, across many instruments, we saw historically low interest rates. Those are still at very low levels. That is still conducive to incentivizing people and organizations to go out and borrow money, which helps to fuel economic activity. Fiscal stimulus, both on an absolute and relative basis, the United States is spending more money than we have ever spent, and we are the outperformer around the world when it comes to fiscal stimulus. Even relative to what we saw 10 years ago, where the United States was a significant laggard, we are definitely in the vanguard of spending money to support the economy. This is of a magnitude far greater than anything that we've experienced over the last 3, 4, 5 decades. And then again, pro-cyclical forces, the idea that the economy is starting to right itself. We are also seeing that acceleration to a greater magnitude than what we've experienced in recent history. So all of these features are still germane, but we are seeing them to a greater magnitude than we normally do in a recovery. That contrasts with what I'm showing you over on the right side of the slide, which are things that are different relative to a typical recovery. When I say reopening and dry powder, I don't mean the same thing. In fact, I mean things that are on opposite sides of the economy. When I say reopening, I mean the ability of businesses to open their doors as states start relaxing constraints, as the CDC starts putting out guidance about how many people can be indoors and whether or not they have to wear masks. Not all states are moving at the same speed of this reopening, but we have clearly come a long way. And I think as the economy fully reopens over the next quarter or two, we are going to bring more of the supply side of the economy back online. Because again, economics is about production. We need to be out producing things in order for the economy to grow. As businesses are able to operate closer and closer and closer to full capacity, that reopening will bring more of the supply side of the economy back online. What I mean by dry powder is a lot of the proverbial pent-up demand that you've been hearing about over the last year. Figures differ, but we are clearly talking about trillions with a T, trillions of dollars that U.S. consumers are sitting on that they have not spent over the last year. And you largely don't need me to tell you that if you've lived anywhere in the world over the last year, but certainly within the United States. as we start to resume some function of normal lives, some of that pent-up demand of things that didn't occur over the last year are going to get pushed forward in time into this year. That is going to unleash that pent-up demand that is going to boost the economy in the short run over the next year to 2 years. Therefore, I think we are dealing with an incredibly optimistic perfect storm recovery outlook over the next year to 2 years, where the economy is going to grow well ahead of capacity during that time. But I'm not just optimistic about the short term. If I switch gears a little bit and I think about the medium term, about the medium run perspective, my optimism doesn't just fade after the next couple of calendar years. I actually feel pretty optimistic about the outlook for the economy over the medium term, which of course raises a good question. Why do I think that? Why do I not think we're just going to have those factors conspire together for a couple of years, then they will abate and we'll end up back on the same trajectory that we were on before we got into this mess? I want to go back to this idea about production, because fundamentally, economics is about production. It's about taking inputs and turning them into outputs. Inputs like labor, capital, natural resources. We take those inputs, we run them through what I call processes, things that we do to them, and then we turn them into outputs that we use in our lives. Things like automobiles, smartphones, or really exciting economics presentations. All of us who are out working in the economy on an everyday basis, whether we know it or not, are taking those inputs, doing something with them, and producing outputs. And how efficiently we could take those inputs and produce outputs says a lot about our ability to grow as an economy, because there are two fundamental ways to grow an economy. We either have more inputs, more labor, more capital, more natural resources, or we more efficiently turn those inputs into outputs. And it's that part of the process, if you will, pun intended, that I want to discuss with all of you today. How do we make ourselves more productive in the medium to long run? And that brings me to a concept known as the Salow Paradox. If you haven't heard of the Salow Paradox before, I find it incredibly interesting. The Salow Paradox, or more broadly, the productivity paradox, referred to this period during our economic history in the United States where we had a slowdown in productivity growth. How efficiently we were turning inputs into outputs was actually declining over time in the 1970s and the 1980s, despite the rapid development of information technology. And this is attributed to a very famous economist, Robert Solow, because of his very famous 1987 quip, whereby he said, you could see the computer age everywhere, but in the productivity statistics. What he meant was, you could actually see us as an economy investing in the kinds of technology that could make us more productive. Think about what life was like in the nascent stages of a lot of this home technology in the 1970s and the 1980s. You could literally walk around and see computers starting to pop up in lots of different places, but you just didn't see that in the productivity data. And some have wondered, myself included, over the last 10 years if this has come back. Let me just show you the data from the 70s and the 80s, and then I will show you why I'm thinking about this in the context of today. I had to smooth out the data over time, otherwise it looked like somebody's bad EKG and it wasn't giving you a lot of signal, it was giving you a lot of noise. What I'm showing you on this slide are 10-year rolling growth rates for both labor productivity and private investment. If you look at the box toward the middle left side of the slide that encompasses that period of the 1970s to the 1980s, you could see what Solow was concerned about, that the red line productivity growth had slowed down from the 70s into the 80s, even though that black line of private investment, it stayed at relatively robust levels. Eventually, as we got into the 90s, you could see both of those things really starting to trend up. We start to see improvements in labor productivity that are more congruous with what we were seeing with investment in the economy. I'll come back to that in a minute. Hold on to that thought. But I want to switch gears and look over on the right-hand side of the slide, because the right-hand side of the slide has parallels relative to what we saw in the 70s and the 80s. You could see the red line after the mid-90s starts to trend down again. Productivity growth starts to decline, and now we're at 10-year rolling growth rates that are at or near historically low levels in ways that we haven't seen in a very long time. But look at the black line. Investment has actually been trending up on a rolling basis over the last decade or so, as we've invested in the kinds of things that I'm sure a lot of you are thinking about and interested in. Things like AI and machine learning and robotics and automation. It makes one scratch their head and say, Are we repeating what we saw in the 1970s and the 1980s? And how does this get resolved? And that's really what I want people to think about. Let's do the 1990s resolution first, and then I'll talk about what I think could be the potential 2020s resolution of this dynamic. If you go back to the 1990s, we started to see some very important changes that caused productivity growth to boom. We saw significant improvements in CPUs, the chips inside computers that really run things, especially around 1993 when Intel migrated from, I don't want to dwell on this too much, but from 486 technology to Pentium, 5th generation technology. Computer processing just started to get a lot faster and more powerful. At the same time, we had enhancements to the global supply chain, especially in the context of globalization. Think back to how we think of globalization today. A lot of that started in very embryonic stages in the 1990s. And then, of course, the advent of the information age. Information, communications, technology, the kinds of things that we are still using today to have a presentation like this really got their virtuous start back in the 1990s. And then eventually, like I was showing on the last slide, we just got to a point of critical mass of investment to unleash those forces and boost productivity growth from about the mid-1990s through the mid-2000s. That brings me to thinking about the parallels for this potential resolution. Unlike the 1990s, we are now seeing improvements in not CPUs, but GPUs, the chips that actually crunch the numbers for graphics. Once upon a time, the idea was to have chips that could more efficiently produce graphics for video games and CAD and things like that. But what people learned along the way was the math involved in that is actually really useful when we're trying to crunch big data, lots of numbers. So improvements in GPUs over the last 10 years have been really beneficial to actually unleashing a lot of the potential for data analysis. We've also had improvements in e-commerce over the last 20 years, logistics capabilities. I liken it not to the exact same degree, but similar to what we saw back in the 1990s. And then I think where we are really seeing lots of parallels with the advent of the information age, the real advent of, however one wants to think about this, the artificial intelligence age, AI, machine learning, automation, cloud computing, all of those things. We have clearly poured a lot of money into that technology over the last 10 years or so. I think we are just on the precipice of this becoming a critical mass of investment. Why do I think that? There are lots of reasons why I think that, but this is maybe the best evidence that I can give you in support of that. This is the results of a survey that Bain, the consultancy, produced. And they polled a lot of senior business leaders about their attitudes toward automation. And what you see with the black columns, which are their attitudes before the pandemic, versus the red columns, which are their attitudes after, it's shifted from being very bottom line oriented, growing revenues, reducing expenses, driving bottom line earnings growth, to things that are a little more durable. Business continuity and resilience, lowering the risk profiles, generating insights, things like that. Where the rubber meets the road on this survey is that Bain concluded that over the next 10 years, American businesses would spend somewhere in the ballpark of about $8 to $10 trillion. And if the law of large numbers numbs you a little bit, just to put that into context, the entire market capitalization of publicly traded semiconductor firms is only about $4 trillion. Somewhere around 2 to 2.5 times that amount they expect to get invested in this kind of technology over the next 10 years. If we approach anything like the numbers they are throwing around, this will almost certainly be a game changer for productivity growth and economic growth as we start to think about that medium run, how we get through not just the initial boom over the next 2 years, but actually something a little more durable that can keep the economy running at least marginally hot for a while. I don't want to oversell you on this. I'm not a politician running for office, but I do think there's the potential for greater than pre-pandemic capacity growth. And lastly, that brings me to the office perspective. And I say, I think it's better than many people perceive it to be. And here's why I think that. Obviously, this is a function of how I view the economy in the short run to the medium run. But how did I come to that conclusion? What I did was I went back and I looked at historical cycles for commercial real estate. And what I wanted to know is how long it took them to stabilize after the economy stabilized. I looked at points in time where the economy had bottomed and then calculated on average how many quarters after that the national vacancy rate in the United States stopped increasing. So I did this for all of the major property types. I want to focus on office today. Maybe at some other point in time, we can discuss the other major property types. But start with the leftmost column. Obviously, they're all the property sectors If you go one column to the right, the time of the economic bottom, I think it's fair to say that the economic bottom was in the middle of last year. The economy has grown for 3 consecutive quarters. And clearly, given my positive economic forecast, I do not think that we are going to be backsliding past where we were last year anytime soon. I feel pretty safe pegging that at mid-2020. Then if I look at, on average, over the last 4 to 5 real estate cycles, how long it took the vacancy rate to stop rising after the economy stabilized. And you see for office, it took about 8 quarters on average. After the economy hit bottom, it took the national office vacancy rate about 8 quarters, give or take. If I take the middle of 2020 as the bottom and I roll that forward about 8 quarters, you get to about 2022. That's the fourth most column, which I'm calling history projected time of peak. Now, I don't forecast on a quarterly basis. I forecast on a calendar year basis, but this point will still stand. What I did was I compared that history projected time of peak to my model projected time of peak, the econometric model that I built. And they're basically showing the same thing, 2022. And that is really the important takeaway, that despite the most dire prognostications about the economy, about the office market, that we are not going to see something inordinately bad. I'm not saying that there isn't pain left to be felt. I don't want to sugarcoat this. I'm not saying that all markets will come through this in the same manner. I'm simply saying this doesn't feel like an inordinately bad downturn to me, relative to what we've seen in the office market over the last 4 to 5 cycles. I think both the economy and the office market have outperformed those most dire prognostications over the last year or so. Just to summarize real quick, my so what are the takeaways from this? I think given the speed with which the economy is going to recover, people in the office market need to move fast. Procrastinating, equivocating is going to lead people to miss good opportunities. Be thinking about decisions even if you're not willing to make them right now. Expect better. I don't just think this is a 1 or 2 year phenomenon in the economy. I think that we can actually be on a higher growth vector than we otherwise would have been. And I think that has great implications for the office market moving beyond 2022. And then lastly, be prepared. I think the office market is going to fare well relative to historical comparisons. I feel pretty confident in saying that. I think if you're hearing a lot of doom and gloom, I'm not so sure that's the right way to be thinking about this. I'm not saying go out with unbridled optimism, but I feel confident that relative to those most dour prognostications, we are in for better times than that in the office market. With that, I will conclude my remarks and say thank you very much. Have a good rest of the conference.
Thank you, Ryan.